Hey there, welcome to the Presidio Perspective. I am Dustin TenBroeck. And this is Luke Jacobson, everybody.
That was my attempted humor at a April Fool's joke for Sierra, but we whiffed it.
Oh, man, look at it. You can breathe now, Sierra. It's good. That's nice, Luke.
Cheers.
Cheers. Good to see you, man.
Yeah, right on.
Well,
April 1st?
Yeah, April 1st. We're here with you today. We have a really packed show. We have a lot to cover. I hope you're listening. We're going to have a lot of good information for you that is critical, I think, to being successful with your own personal wealth management goals. So let's get right into it. So starting off, I'll go over the rundown really quick. We're going to talk about COVID update, what's going on, the vaccine distribution, what we're seeing out there. What I'm seeing is traffic. I don't know if anybody else is seeing that, but certainly we see the reopening continuing to happen.
Patience.
Yeah.
They're like learning patience all over again.
Yeah.
That's what's happening today.
Yeah. Finding your chi, exactly. But we're going to talk about the big three. Okay, and as many of you know, the big three are the three most critical wealth management items that you need to plan for. They are inflation, taxes, market crashes. All of them want to make your money worth 40% less, and they will, given the wrong strategy. We're going to help you do the math, show you what we're looking at, as always, with our perspective here on the show, and what maybe you need to be looking at as well. So, Luke, the vaccine rollout's going down. The cases are down. In the COVID world from a year ago, it's night and day.
Night and day. Have you scheduled your vaccine yet?
Speaking
of that,
I have.
I haven't been able to schedule my vaccine yet at all. I don't know whether I just have no idea how to use a computer, my phone. Maybe it's just that I'm over 40 versus that. But I've had a lot of friends that have actually scheduled and taken it, and I think that's a big part of why we're seeing what we're seeing today.
Yeah, Sierra, if you want to bring up the second image, number 2, we'll just look at the distribution, and this is as of a week ago. But this is the percentage of the population at these different age bands who have already received at least one dose of the vaccine. And these numbers have grown drastically in the last week. So this is as of March 23rd. But, you're seeing 70% plus of people over 65 have already received the vaccination. And yes, people in Luke's demographic and mine are starting to receive that vaccine as well, at least have it scheduled and coming on board. So, the vaccine rollout's happening. We're seeing a tick down in cases, what that might mean. So at least in the U.S., that looks very good, and why you're seeing traffic on the roads likely, and why there's such optimism out there in the markets with recovery.
Right. I feel in my search for a vaccine, I somewhat feel like it's the original search for toilet paper. Right. At one point in time, you felt like you couldn't find it anywhere, and I feel like I can't find a vaccine anywhere. But in 1 week or so, maybe even 2, I feel like there's going to be vaccine doses suitable and everywhere for anyone in my age demographic, all the way down to even 18.
Yeah, and April was the month that they were saying they were going to really roll it out to everybody under 65. So this is where you're going to see a lot of distribution. So over the next coming shows, over the next 2 to 4 weeks, we'll keep looking at these numbers together. But already, we're on target or above target of where we were hoping to be at this point in the year.
Right, and it feels like it's gaining momentum. I talked to a friend yesterday. He said he went to the Chula Vista Super Site, and he was in and out in 6 minutes.
Yeah.
Right? So for anyone who hasn't actually scheduled or gotten a vaccine, it seems like a lot of those challenges are behind us. At least the momentum is in the right direction and gaining speed substantially.
Here in the U.S. at least, right? And it's different across the globe. If we look at image 3, Sierra, we're going to just kind of do a comparison. Now that this data is a little older, so but what we've seen in the U.K. and the U.S. is a very quick distribution of the vaccine to the population. And so as a total population, we're seeing over 30% of all U.S. Citizens have received a dose, and that number is climbing. And that's very different when compared to the rest of the developed world and, of course, those developing nations as well.
Right, and the developed world is still just coming out of shutdown.
Yeah.
So at the end of March, you had a lot of Europe actually pull out of shutdown again. And when you look at this data, if you haven't seen this before, you can kind of see why they were in shutdown. They're worried about other variants. But I expect similar momentum in these developed countries and developing countries the way that we've had the U.S. and the U.K. recently.
Right. And I mean, certainly how you play that in your portfolio is you want to buy before the fact, right? And so if you're looking at this, you can say, okay, this is why the US and UK might be leading the financial markets. But what does that mean when we look abroad overseas for the future of some of these other developed nations and emerging markets?
Well, you could see further reopening, and what would follow that would be policy action, policy responses from those areas. So right now, the dollar is still king of the land. People are continuing to sell their currencies. They're buying U.S. dollar, and they're acquiring U.S. fixed income instruments because it's still the highest rates in the globe. Will that maintain its status as it has for the last year and last even 3 years? That's a big question, but there's a really good chance that there could be competitive threats on placing assets for fixed income bets.
Yeah, absolutely. Right. So the U.S., even though interest rates are so low, is still higher than most of the developed world, which kind of feeds this demand for our treasuries and the U.S. dollar, right? They get just a little bit higher interest, or at least not negative interest,
right?
Which is important for a lot of nations and sovereign governments, right? Looking at where to place their cash in dollars. Over the last 30 years, though, if you look at a chart of the U.S. dollar, it's relatively stable, right? And this is why it's the fiat currency of the world to date. And so, it is priced a little bit above its historical average, right? And so we're going to talk about inflation in our next segment and what that might mean.
Right.
Final thing on COVID, though, which I thought is pretty interesting. This is a study released by First Trust. And so if we look at image number 4, Sierra, this is what they call the path to immunity. So some of you out there, are sitting on the sidelines and saying, do I really have to get the vaccine, right? So maybe not. We need a certain amount of the population to get it. But, what they're looking at is the amount of antibodies out there in addition to the vaccine rollout. And so folks who've tested positive for a vaccine, which are much smaller than what we theorize were people who've actually contracted COVID that did not get a positive test, right? You know that you were exposed, you were ordered to stay home. I know many, many individuals that were in that camp. So we think that's even more than, the U.S. infections are greater than those that actually tested positive. And then you add to that the total folks who've received the vaccine dose. And so that number is rising, right, as we kind of look at this path to immunity. And again, the CDC is saying once you get the vaccine, you can stay indoors, not social distance, not have a mask. Again, you kind of have to say that. I don't know too many people who get a vaccine. If you said you could get a vaccine, wear a mask, and still social distance, and you can't go indoors. So, I'm somewhat skeptical, but it's good news. I'm going to, be hopeful that that is the case until we get further information. So, So anyway, all good news so far on the vaccine rollout, right? We haven't had any bad reports about any adverse effects from the vaccine, and it's been pretty smooth getting it to the most needy segments of our population, which are at most risk of the COVID virus.
Right, and what's impacting my life currently as I reflect about the changes that we've made with vaccination and COVID is my kids will be going back to school here in a couple weeks, and the dynamic changes that will make in my life and my kids' life, family's life, but also the things that we will do just by driving to school, coming back to school, the amount of commerce that we will be experiencing just in those movements, and all of the collective effort of everyone getting back to a whole new routine is explosive for economic environment. It really is.
It's interesting. There's a lot of talk in the U.S. and especially on Wall Street about trying to theorize what the post-COVID world would look like, even just a couple months ago or a couple weeks ago for that matter. And we've heard some really big news from really large corporations in Silicon Valley that we all know and love. Some of the biggest companies are reporting that this month are bringing folks back into the workplace.
Yep. And debates are already starting about what does that look like. Some people are coming out and saying, we need you to be at work for us to be collaborative. Others are saying we're going to give people the opportunity to stay at home. I'm writing my quarterly investor letter right now, and I've really reflected on the last 12 months versus the next 12. And I would say 9 months ago, I thought we would go back to something that I knew my life used to be like. And as I look forward, I don't see me moving forward in a life that is exactly what I remember. It will rhyme with that, but it'll be really different. And I think that has really big implications on our portfolios, on investments, and what can really flourish over the next 12 months.
Sure.
And I don't think it's so simple just to think, oh, we reopen, we go back to where we were. It's going to be quite different.
It'll be interesting to see.
Yep.
Absolutely. All right, so that's our COVID update. Let's move on to inflation, something that I think we've talked about in just about every episode of the show, and there's a reason for that. Mm-hmm. So, Luke, what are we seeing in the new inflation numbers that are coming out?
Well, let's just start with, if we want, Sarah, we can put on number 4 here.
Number 5, yeah.
Number 5, sorry about that. So we're looking at inflation since 2010, and I think it's kind of interesting to just we're talking about inflation. And if you look at this chart over the last, since 2010, so the last 12 years, inflation has been really benign. It's been below an average trend of 2%, which 2% used to be the high end of our monetary policy target. And this is a chart that shows in the dotted line here on the right side from 2021 to 2025. Goldman Sachs has an estimate of inflation effectively moving up from low 2s to mid 2s, moving from a 1.8 to a 1.95 to a 2.15 over the next 5 years, which basically says that inflation is coming back in some way, shape, or form. I wouldn't say they're making a huge heroic bet here, one way or the other.
Right.
It's not like they're saying it's 3 or 1. It's very close to that central tendency of 2. But I would say inflation has a large potential to be a part of our lives where it really hasn't been for the last decade.
Yeah, and it is a compounding silent killer. It's in the room. We can't see it, taste it, smell it, but it's killing the value of our money every second, every minute of every day.
Right.
And I don't think people realize, if you are fortunate enough to find some bank instrument that gives you a 0.5% interest, and inflation is running at 2.5%, you are losing 2% annually on your money, and that's really modest inflation, right? So over the next decade, you're going to see kind of best case scenario losing 25% of the value of your money for anything that's sitting in cash earning 0.5%. That's what the math would suggest, right? Compounding 2%. It could be as much as 35%, right? If that ticks up to 3.1. And so inflation is that silent killer where we look at the statement. I had $100,000 a year ago. I still have $100,000. I protected all my money. In fact, we lost. Right. And as inflation goes up, right, likely because interest rates aren't going to move up with it, then we're going to see that loss of value.
Right. What if I told you that I had an investment idea for you, locking up your capital for the next few years like an alternative investment, and it was going to return you 0 but cost you 2% a year?
Yeah.
What would you do?
Right.
You would move on.
What else do you have?
What else do you have? But more often than not, when we're reviewing new portfolios, new relationships, one of the things that usually sticks out is too much cash. One of those kind of red lights that flashes off say you're very suitable for some help through this issue. And I think that is going to really eat away at individual portfolios and just be that silent killer you talked about.
Yeah, absolutely. So one of the big 3, you need to have a strategy to combat inflation, and we expect there's going to be a lot of it. So again, this is over the next 5 years. If you want to look at over the next 10, we have some facts and figures for you here in our next segment that suggest, we could be in for a wild ride when inflation is coming to pass. So let's move on to the next killer, right? The next one of the big 3 is taxes, right? I am going to go out on a limb and say your taxes are going higher.
All right, tell me about that. All right, tell me about my taxes are higher.
Yeah.
I don't like that.
Yeah.
If anyone wasn't listening, they're listening now.
I hope they're listening, right? Because what we do with the big 3, inflation, taxes, market crashes, our defense to these things is to pretend like they do not exist. Right? We pretend like we protected our money in our bank accounts. We protect that so long as I didn't pay the taxes on my capital gains or withdrawals from my 401k, that the money's still all mine. The taxes are due. You're going to have to pay them. When and how you pay them is going to matter significantly to your financial success. Right. And so let's just kind of look at some of the numbers, right? So last year, 2020, we ran the largest deficit so far to date, $3.1 trillion. I don't think that was going to be a shock to anybody that we were going to run a deficit last year during the COVID pandemic, but $3.1 trillion. Right? Substantial, way larger than in 2008, 2009 during the financial crisis. Okay, that was at the end of last year. So far, we've had a blowout $1.9 trillion stimulus bill already on top of that.
Right.
And now a proposal for an infrastructure spending bill that could be $4 trillion over the next decade.
Correct.
Okay.
We've already ran up our credit card debt effectively to our income levels. So our debt to GDP is already over 1 to 1.
Yeah, and so if you just look at, and that's very helpful, right? For me, I like to look at, okay, if this U.S. economy was a client of mine, and I'm going to look at their income,
Right.
their expenses, their assets, their liabilities. We call that ALLI, right? The 4 variables of your personal wealth and finance, and see what's going to happen. So imagine somebody coming in saying they make $100,000 and they spend $116,000, and they put that on a credit card.
I can model that out in the future for you if you want 30 years. It doesn't look good.
I've done it. I've done it. Let's share that. So the deficit is the largest we've seen. The debt is growing, right? And so what are we going to have to do? Well, you have to cut spending. That's not happening. We are increasing our spending.
Right.
So what we're going to have to do is increase revenue. And where is the source of revenue for the U.S. government? It's taxes. They have one source of revenue, and that's what it is. Okay, so we already know that the Biden administration has made a campaign promise and pledge to increase taxes, seemingly drawing the line at that $400,000 mark and increasing taxes on folks who make more than $400,000.
Right.
Okay, however, let's just do the math, okay? So let's say they take what has been proposed, a 37% bracket to 39.6. Okay, now we just have data from 2018 to model what that would equal in increased revenue. So if they increase the bracket from 37 to 39.6, that would yield an extra $20 billion of revenue. Okay.
So wait a second. Did you say 20 billion?
Yeah. So
in front of the
1.9
trillion
trillion and the 4 trillion. So that's another 20 billion a year. Okay.
All right.
So let's say they said, okay, you know what? We'll violate our campaign promise and we'll raise taxes on the 35% and 37%, raise both of them to 39.6. Okay, that would be an extra 13 billion on top of the 20. So now $33 billion.
Right.
It's like trying to fill a pool with a teaspoon.
It's not happening. So
I got one more for you, Luke.
all right.
Okay.
I don't know if I can take another.
Okay, because it's important to understand why I have this theory that your taxes are going higher.
Right.
Regardless of if you make over or under 400,000. So let's say they took the 35 and the 37% bracket,
right,
and they blew that up to 100%. And in some crazy world, people making over that $209,000 single or $416,000 married continue to go to work and collect no revenue, pay 100% of their paycheck to the IRS. That'd be $681 billion. Okay, and which is a pretty massive violation of the campaign promise. Certainly something they can't do. But we just see how big this issue is. And look, let's do some of the math here. So what we've done, right? Since we spend more than we make. Sierra, if you can pull up number 9 for me. We're putting it on the credit card, right? So this is our federal deficit. And I'll just have you blow this up, Sierra, and so folks can take a look. So what are some of our major spending items for our federal government? So let's look at Social Security and Medicare, 2 of our biggest spending, right? Social Security is over 5% of our gross domestic product and increasing over time. Medicare is about 3% and increasing to over 6% over the lifetime of this. So this is over the next 30 years. And in the red is our net interest expense. And look what starts happening over the next 30 years because of our borrowing. This is from the Congressional Budget Office of where our projected interest expense is going to be in the future, right? It's going to be larger than what we pay in Social Security and Medicare. So we know that this is going to be an issue, okay? So Sierra, can you go to number 10? Okay, so that's what some of our expense budgets are. Well, let's take a look at the whole income statement. So what do we have projected to come in? Revenues are in blue. Okay, so this is, looking back, revenues that we've collected back from 1970 and projected over the next 30 years. So those are the revenues as a percentage of gross domestic product based on the current taxes. And these are our expected outlays. You see that big spike, right, from pandemic. And then here is the layering on of the forecasted spending that's going to go forth. This is without the infrastructure spending bill. So we're going to have some pretty big outlays, and there's a gap. So when you make less than you spend, you have to borrow the difference. So our deficit's going up. So what can we do? Knowing that interest expense is already a growing part of our budget, is they're going to have to increase revenue. So thank you, Sierra. So look, this is just the start. But we call it the big three, and tax planning over the next 30 years is going to be crucial for your financial success. And especially for retirees, right, that have saved in 401ks and IRAs. What is the plan for making those IRA withdrawals? Are we going to wait and defer capital gains? Are we going to wait and defer ordinary income and take it out in the future? Well, looking at these charts, what we're going to see this year is likely going to be modest than the tax policy changes that we're going to see down the road. And go ahead.
Well, so I just want to bring up a question, just get you live here on the spot. So, you know, a lot of the people that are viewing this have probably met you in class. They've seen you, you know, kind of capture their attention in some really amazing retirement 101 formats. If you had 20 people in your class right now and you just showed them all these slides about where taxes are heading, how many people would immediately jump on a movement from qualified tax-deferred status accounts and start doing Roth 101 or
Roth IRA
IRA conversions, or how many people would just keep doing the same thing?
I mean, my goal of anybody who sits through our Retirement 101 course or that we meet and counsel personally is to get them to at least take off the blindfold and just understand that they will pay taxes and to do the math. And if you are going to continue to defer your retirement accounts, you are telling me that in the future you think your tax rates are going to be lower than they are right now.
Well, that's just what's going to happen, right? I go to work, I put in my qualified plan, and then I pay lower taxes later. That's what they tell me.
So if you went to work in the 70s, that was true, right? And so, you know, when 401ks came about in the 1980s, the math looked very good. You know, coming out of the high tax rates that we had in the 70s, you're going to defer. You know, it's just likely not going to be the case. And we have all the evidence here that we're sharing with you today. We'll continue to review. But look, we could get our plan. We still have these massive loopholes in the tax code, which I don't think are going to be forever, that allow us to take these tax-deferred accounts and we tax at the highest ordinary income rates you'll pay, find strategies to convert those to tax-free Roth IRA accounts. That's a big step. And then those that have built up capital gains, right? People who have built up capital gains, we know that this is on the chopping block. Capital gains rates are going to very likely be higher next year. And watch, okay? So, I mean, I'll go out on a limb and make some prognostications for next year, and of course I'm going to be wrong, but I think seeing that ordinary income tax rate go up to 39.6 is a lock, right? We are expecting that.
From what now?
From 37.
From 37.
It's a marginal move, and it's making no difference in the deficit, but they got to start this somewhere, and this is just the beginning, right? Corporate tax rates, we know are going to go higher. Okay, so, you know, there's a very real possibility that those are going to get pushed up to 28%, okay, which, you know, over history is not too outside of the range of what we've seen before, right? We're in the lowest corporate income tax rates we've had. You know, the stock market has benefited greatly from that. And so expect some capitulation in the stock market as we see corporate taxes going higher. Of course, you would have more to say about that. Capital gains rates, right, especially for higher income earners, that top rate is now at 20. I likely see that going to 24 or higher. And the other thing I'm believing is going to be on there, and it certainly is going to be some debate, is bringing back the estate tax exemption. And, you know, they're going to have to raise this money somehow, right? And so I think that's something that I'm less sure about, but certainly watching very, very closely, because in times in my career, you know, Americans that had over $1 million of net worth had to pay 40% to 50% of their estate in excess of that amount when they passed away.
Right, and they'd be moving it from a exemption of what right now, just so everyone knows that right now?
But it's over 12 million. I believe it's 12.65 and per individual, right? So I mean, if you have $25 million or greater, you're facing this estate tax. So most Americans, it's just not something they have had to worry about. But likely, look, we're looking at the numbers. We know the tax rates are going to be higher. So sitting back on the sidelines, this is going to be the year. 2021 is going to be your tax planning year. Okay, so this is the time to get your plans together. Do not wait until December 31st, and certainly don't wait until next April. Okay, so you have some lead time. We have 9 months to put together a tax strategy to help you get set up to minimize your overall taxes.
So good time for a pivot. So in terms of raising revenue, as I'm looking here at this CBO estimates, which honestly I hadn't seen before, and it's actually quite alarming. So we're talking about raising revenues for the U.S. government. One way to do that is through raising tax rates. The other way is to raise GDP output, right? So if I'm charging X percent on a dollar of GDP, if I can make $2 of GDP on the same rate, I can raise revenues. And so I think one of the things that you're seeing now, not from effectively raising rates, but from the Treasury Department or even just from the Fed, is to try to get our GDP rates as high as possible. And that kind of pivots us to our market volatility section, which is the market digesting all these new segments of the market, raising rates, and what's going to happen with the economy here in the next 3 months, 6 months, 12 months. As of today, equity capital markets are marking new highs, and leadership has changed, which is a significant bullish outlook for kind of where we're looking today. And if you would have asked me that personally 4 weeks ago, I probably wouldn't have predicted that. It's been volatility has spiked substantially in the last month, if not the last 6 weeks. And so I'm extremely I'm excited about it. Yeah, I don't mean to be, but I am. I'm very excited about the fact that there is new leadership in the market. The market's broadening out and making new highs. And as of today, today's a big day. Not only is it April 1st to kind of tease our producer, Sierra, but it's also a report that we had talked about a month ago. The ISM report on business today. It was 64.7, which is a substantial expansion even from the last month. This is nearly a record-breaking number. And across the board, what we're seeing is this pig in the python type scenario where demand is going to outstrip supply here in the near term, right? So even just in our own personal lives, the things that we want to do that we haven't done for the last year, we want to do it all right now. Everyone wants to go on vacation. Everyone wants to do X, Y, and Z right now all at the same time.
Yeah, we talked about it last episode. The U.S. consumer is strong, and they have pent-up demand, and they want to spend. Companies know that, and so if you're out there buying a car right now, buying a house, it's tough.
It is tough.
You're buying full price and over. You think you're going to get some concessions at the dealership? They don't have any concessions for you. They don't have to. They're selling at full boat. You're buying at a higher value. You want a discount? No.
They will definitely teach you about how little you know about negotiating.
Yeah.
Right on that lot if you want.
Right now, they don't really need to, right? Somebody else is going to come behind you and buy the car, buy the house, and so that's where we see these rising prices. You've spoken about this pig in the python before. We see this demand spike, so prices are going to be higher, especially over the next 3, 6, 9 months. Likely some normalization after that, we'll see.
Right.
But, could set some new norms, some new highs, and that's what inflation's going to do. So, yeah, that's just kind of what it looks like right now. But, the market crashes. I always talk about the big three, and not like we're alarming people that we're on the precipice of a market crash. But it is the largest concern that I find that people have about their wealth, their retirement portfolios, and the biggest hang-up they have to being successful financially is just the fear of market crashes. So I just wanted to make sure that it was important that we talk about. Because when we see that we're reaching new highs, I'd say more than half of the folks I talk to, that is a problem signal for them, right? Which is in a bull market, what you do is you reach new highs, as you know. But for many who lived through the 2000s and saw new highs just to come down and new highs to come down, that still resonates with them as, oh, this is going to be an issue.
Well, let's differentiate between market volatility, market crashes, and what I would call just a market drawdown. Market drawdowns are just a normal course of business, but they're not fun.
They don't rhyme with taxes, Luke.
They don't rhyme with taxes.
No, inflation, taxes, market crashes. We gotta
keep with that. But if we think about them as normal course of business of having market drawdowns and building a portfolio such that the volatility in your retirement account doesn't knock your fillings out. That's what we do here for our clients.
Exactly, and that's why you have a strategy. And so, do you have a strategy that's going to help protect you from inflation, that's going to navigate you to pay less in taxes on your income, and your earnings, right? So if you make $100,000 in your investments, do you keep $100,000 of that? Do you keep 80, 70, 60, 50? That's all based on your taxes,
right?
And your tax strategy and where you invest and where you own that account. In market crashes, we expect, just like inflation and taxes, we know they exist.
Right.
And so we experience this relatively recently in 2020 with the COVID pandemic. We know that markets are going to go through really bad times, and it could be scary. And those are times to work closely with your wealth manager and understand your strategy and what your time horizon is.
Right.
Because if you've been able to build yourself a long-term time horizon, you can really benefit from this tremendous growth and wealth. And look, Luke and I are always going to be able to come here on the show and talk about 5 to 10 things that concern us in the market, right? But over the long run, it's not going to take down the trajectory of building wealth and how you do that and putting the portfolios together.
Well, time horizon, right? So I just want to reflect on that comment, time horizon, and what a plan and what proper asset allocation enables you to do is it enables you to refocus your time horizon such that you're not focused on how is the drawdown in my portfolio impacting me today and I'm getting so nervous about it. You're able to really reset and think, okay, I have a set of investment opportunities in my portfolio that are underperforming today because we're having this massive change in environment where everyone wants to go out and stop working from home, stop watching podcasts potentially, or just watching watching Netflix
Listening
at
in
home,
their car, though.
right?
Yeah.
So that's changing, and so I want to be able to change my focus to what could be doing really, really well in Q3 of 2022, and a plan will help you to maintain that focus and allocate to investment opportunities that really work well over the long run.
It's great to look back. This is our 8th episode of the 2nd season, you know, and if we just look back to all the stuff that we've been talking about over that time frame, there's just been so much news and headlines, and we only talk about a very small portion of it on this show, right? But all the reasons for the ups and the downs and all that we've experienced. But if you go and look back at the Standard & Poor's 500 index, right, back on our first show, it was at 3722. Is where it closed that day. And here we are, 8 episodes in, and it's 10% higher.
And what's the big change that's happened also between that time frame? I think it's really important to point it out, is that the U.S. 10-year, when we walked out of our offices, was at 1.68. It hit a high of kind of 1.75, 1.74. And if I just reiterate what we said a few minutes ago, the markets are hitting new highs. So it's slowly digesting that new information, a slow change in rates. Rates can go up, markets can go up together. I think it's really important to think about what's actually happening right now.
Yeah, now we're going to talk about a lot of changes that you're going to see that are going to increase volatility likely in the stock market as we move forward, as you like to say, from hope to growth, right? So over the last 12 months, all you could do was hope. There was no earnings. There were no fundamentals to look at.
Correlations were one.
Yes. I mean, you just had to really put your money in and hope that it's going to get better, right? And there's a lot of reasons to do that, a lot of reasons not, right? And so now it's these companies that have to report their earnings are going to be judged on the math.
That's right.
Right? And corporate profits times some multiple that's usually based on risk tolerance of the overall market is going to drive that stock price.
Right. It's not going to be as simple as just picking a new growth name and just writing that up 300%.
Right.
It's probably not going to happen. And stock picking, asset allocation, selection is going to become more important over the next few years. And the returns are predicted to, we'll see if this really happens, but they're predicted to be potentially more muted
over the long run,
but also having higher standard deviation, so higher volatility. So allocation and planning becomes even more of a priority in that scene.
But right now, for the information we have, the fundamentals look good. You've had this new broader market leadership, which looks very, very good for the overall stock market. You've already seen the interest rates tick up and kind of normalize. That's been digested. A lot of this tax information is likely already priced in the market. Wall Street knows of this pledge that the administration has had. And the technicals look really good, right? And not like I'm a big chart guy, but we only get fundamental data every quarter.
Right.
So in the interim, you have to kind of look at something else that kind of theorizes what those fundamentals might be.
Technicals matter. They tell you it's supply and demand of what people are buying and selling, and what it tells you is that people are buying the United States stock market right now.
Absolutely. Yeah. So we don't want to be sitting back on the sidelines, not participating, losing our money to inflation. We don't want to be sitting back in our retirement accounts and capital gains and not pretending like we have to pay the tax. We want to come up with a strategy to be invested for the long run, know how to minimize your risk for money you need in the short run, and minimize your taxes. You'll be very, very successful in your retirement and wealth management years if you can handle these big three. We teach a whole lot about this big three at our sister company, retirement101.org. So many of you have likely seen the course. If you haven't, go check it out at retirement101.org. It's $149. It's on video, on demand. You can go at your own pace. 13 different lectures. We go over inflation, taxes, market crashes, how to build financial statements, how to choose the right investments for your portfolio, how to not buy bad insurance products that could dethrone your wealth, and a whole lot more. So it's a very small investment for the dividends that it pays. Or if you've taken the course and you'd like a refresher, it is there for you on demand at retirement101.org. And you can learn how to stay ahead of these big three and learn those specific strategies that are going to help minimize your taxes and hopefully better allocate your portfolios for the long run. So, all right, Luke, how'd we do? Not too bad. Got into 34 minutes. So as always, Luke and I are here available. So check out our course at retirement101.org. If you have any personal questions that we could answer for you, please give us a call here at the office, 858-461-4959, 858-461-4959. Dustin and Luke are here to talk to you and help you out with any specific questions you might have. Luke,
all right.
As always, a pleasure, man.
Cheers.
All right.